This is an important question to ask them. Always ask your broker, how many lenders do you have on your panel? If they're 15 or lower, that's a red flag. Some of them are down at sort of like the 5 to 10 mark or 5 to 7 mark. Those are a definite red flag. But when we talk about 60 different lenders, I can probably only name about 10 banks or lending institutions off the top of my head. The other 50, or however many there are, should I be worried about using non-banks and lenders that I've never heard of? Hello and welcome. You're listening to Dashdot Insider, the auditory centre for passionate property investors seeking a life of freedom, choice and abundance. I'm Emil Pinder, your host, and joining me again today, Callum Rhodes. We're delighted to have you back, Callum, and we are recording part 2 of Your Questions Answered, everything every property investor should be asking a mortgage broker. We've had a ton of questions that have been sent in via our social channels, and we've been asking clients and prospects, what things do you really want a mortgage broker to answer and to tell you without having to call them up on the phone? And so that's the purpose of this podcast. We did have part 1, which was released last week. If you haven't had a chance to listen to part 1, I definitely recommend that you do so. But don't go away from this because we're about to jump into a bunch of chunky questions as well. But first up, Callum, how are you feeling today?
I'm feeling very blessed to be sitting in this seat with you 2 weeks in a row. I'm really looking forward to cracking into some more questions.
Alrighty, well, without further ado, let's rip into the first one. One thing pops up fairly often is how much difference does a 7% yield versus a 4% yield make in your borrowing power calculations?
I think this is one that gets a little bit misconstrued by people. So whilst your rental yield is important, there really is diminishing returns between, say, 7% and 4%, to use that example. The number one reason for this is the bank's shading effect. So as you're probably familiar, banks shade the rental income that you receive. So they might take somewhere between 20 and 30% off the rental income that you receive.
So shading means there's a part of the rental income that the bank is not counting. They reduce it. So a shading of 20% means when they're doing their calculations, they're reducing the rental income by 20, 30%, something like that.
That's correct, yeah. And then the other part which often brings those two yields closer together is the costs to hold the property. Oftentimes, if you're looking at a 7% yield, you might be talking about a very regional property where your management fees to the agent are substantially more, might be an older property where there's more repairs, and the banks factor all of this into their serviceability calculation. So oftentimes what you'll find is that difference between the two really starts to shrink. And then you're also limited by most banks having a maximum rental income yield of 6% anyway. So to answer your question, the influence on your overall borrowing power is a lot less than what people think.
Okay, and from the way you've described it, it sounds like it might be a bit of a mistake to focus just on what is the yield, because depending on other factors relating to the property, it may be assessed at much lower than what the actual yield is, and there might be a lot of other costs involved as well. So looking just at the yield could sort of put you down the wrong path, could get you spending a lot of time researching or even purchasing a property because you go, oh, that's an awesome yield. But in terms of how much cash you actually get at the end of the day and how the bank is going to assess that property, it might not be the smart option. And sometimes, would it be the case that the 4% yield can come out better?
Definitely, yeah. And I think if I say this to clients all the time, is an extra $50 per week from rent in your pocket going to make a difference in your asset position in 10 years' time? Probably not. But if that property you've purchased has doubled in value versus not increasing in value at all, you're going to be way further in front by focusing on that property increasing in value rather than a short-term metric, which might be slightly better cash flow.
This is a really important point because I think it has been one of those things that has just been drummed into the Australian public and especially property investors, positive cash flow, positive cash flow, positive cash flow. If you look back when API magazine, right, Australian Property Investor had their magazine, it used to come out, and on the cover, there was always something location related, right? This boom town, that boom town, usually with outdated information, right? It's this place boomed in the last 18 months. It's like, oh, well, that doesn't help me now. But positive cash flow seemed to be the thing. And I know there are a lot of buyers agencies out there at the moment who have this mantra of only buy if it's positive cash flow. If it's not positive cash flow, don't buy it. But that could actually be a massive mistake because of the factors that you just mentioned. So don't sort of I guess I'm talking to everyone listening at the moment, don't necessarily just put on the blinkers and think, oh yeah, yield, that's everything. I need a really, really good yield with low risk. Great. There are a lot of other factors that you need to consider intelligently. Alrighty. Next, is it harder to get finance for property investments as a business owner? I've been told this a lot.
Yeah, I'd say that's a very common misconception that exists in the marketplace. And I would say that the number one factor that influences that, it's really the level of experience of the professionals that you're dealing with. So you'll find most mortgage brokers, quite to your surprise, that they really can't read a set of financials for a business owner properly, especially if you've got multiple businesses, multiple entities. So that's the first challenge that you're going to have, which might lead you to that conclusion. And then I would say the flip side of that is that as a business owner, you have far more flexibility in how you might derive your income, which can actually be of your benefit in terms of being a property investor. So when you're working a job, you just have your wage and that's really it. There's not too much you can do about increasing your income. But as a business owner, you may decide in working with your mortgage broker, okay, we're going to trim $10,000 of expenses out of this tax return for this year, and all of a sudden our profit is at the level that it needs to be for us to be able to buy a new property. Or it may be the case that you decide to pay yourself an increased wage based on what your goals are. So I would say with the correct advice and with the correct goal in mind, there's definitely a lot of advantages to being a business owner as a property investor.
Okay, what about being a sole trader?
Sole trader, much the same. You still have some direction over how much income you may have based on the expenses that you claim in your business.
Okay, so the tips for business owners to improve their chances, basically if you talk to your accountant, or would you talk to the lender first, find out where the goalposts are, what numbers do I need to be hitting in order to get borrowing capacity X, and then go and talk to your accountant and say, this is what I need the profit numbers to be, what expenses can we defer into next year so that I hit those numbers, something like that?
Absolutely, yeah. So the client will usually come to us with a brief. We want to buy for $500,000 next year. We'll work out some rough figures and say, hey, your profit would need to be around X. They'll take that to their accountant and they'll work out some strategy whether that's achievable. And then provided that's the case, the accountant would then proceed and produce the tax returns on that basis. It may be the case that it might cost you a few extra $1,000s of tax, let's say, but if that results in you being able to purchase that next asset, it can well be a worthwhile cost of doing business.
Okay, sounds like manipulation, but it's much better to use the word flexibility.
Well, exactly. There's expenses can fall at different times of the year, whether it's a business expense, whether it's a personal expense. There's some variability with some of those figures your accountant can work through.
Brilliant. Okay. Can you secure a deal, then present it to the bank, and will they commit when they see the deal? So basically what I'm asking here is, what is the process of deal presentation to the bank or lender?
Yeah, so if you don't already have a pre-approval, let's imagine that you're just a new consumer, your mortgage broker will have conversations with the lender and run scenarios by them in terms of whether they've got appetite for this loan, what they're likely to do, all of that sort of thing. But in that case, really all you're being offered is an opinion from someone at the bank. It's really got no weight behind it. So the way that you actually run the scenario properly by the bank is ensuring that you actually have a pre-approval with the bank. So, the amount of money that they've committed to you for whatever property purchase that you've got is essentially set in stone. You just need to be bringing them the property to fit in with whatever metrics they've set for you.
Okay. And what factors influence their decision?
Could be a whole range of different things. Some lenders like particular types of property versus others. Some like particular locations. There's a whole range of different factors that are really based on the lender's policy in terms of whether that deal that you're looking to put together is in the appetite for banks 1, 2, and 3, but banks 3, 4, and 5 might not have much appetite for it depending on the risk of it.
Okay. All right. We're talking about banks at the moment, and one thing that we talked about in part 1 was when you're talking to a broker, make sure they have a large panel because that's going to increase the number of options that you have. And when I say a large panel, I mean a large panel of lenders. And you mentioned some really good brokers could have a panel of like up to 60. And some brokers, if they're down at like 15, this is an important question to ask them. Always ask your broker, how many lenders do you have on your panel? If they're 15 or lower, that's a red flag. Some of them are down at sort of like the 5 to 10 mark or 5 to 7 mark. Those are a definite red flag. But when we talk about 60 different lenders, I can probably only name about 10 banks or lending institutions off the top of my head. the other 50 or however many there are, should I be worried about using non-banks and lenders that I've never heard of?
So the thing that I always say to my clients is you've got to remember who is lending who the money in that circumstance, right? So a lot of consumers can get a bit concerned about a lender that they've never heard of, but the reality of it is they're the one lending you the money. So it's not as if you're giving your money to them and it's sitting in their bank accounts and you should be concerned about where your money's going. The transaction's going the opposite way. So to answer your question, non-banks fill a very important need in the market, especially for a property investor that's looking to push boundaries. It's usually due to borrowing power constraints that you might end up with a non-bank. You can just borrow far more money with them than you can with the major banks, but the good thing is there's actually plenty of non-bank lenders now, such as Resimac and FirstMac, that offer interest rates that are just as cheap as the banks anyway. And whilst it might be a name that you're not familiar with, it serves a need in allowing you to continue to grow your portfolio. And if you're going to let some affiliation to a particular bank hold you back from growing your property portfolio, then I think you're really thinking about it the wrong way. They're really just the tool that allows you to keep growing. It doesn't really matter whose label is on where the money is coming from.
Okay. All right. I like that because I'm not necessarily loyal to any bank, because banks aren't particularly loyal to customers, right? A lot of people think, oh, well, I'm with Westpac, I'm with NAB or whoever it is. They're the ones that I bank with, and they're the ones to talk to first. And a lot of people fall into the trap of just going along and saying, oh, look, what's my borrowing capacity? Because it's an easy conversation to have if you're dropping into the bank for, some other reason, pull some cash out, make a deposit, ask them a question about your current loan on your property or something like that, or renew a credit card, or go and get it activated when they send you a new one. Lots of different reasons why people drop into the bank, and they can just have that casual conversation. And before you know it, they've set you up with a little chat with the manager, and he's telling you what your borrowing capacity could be. And all of it, and you're looking at it thinking, well, that sounds great, but it could be a massive mistake, and it could get you really messed up. Don't necessarily have like this really loyal. I would say it's not necessarily in your best financial interests to have strong loyalty to any particular bank, because in my experience, the banks have absolutely no loyalty to us. They have absolutely none. It's not like you get a special deal necessarily.
Absolutely. And just one other key point on that too, which I think people get stuck on, is your relationship with this non-bank. It really ends up being much the same as, let's say, your insurance bill each month. You don't really do anything with them apart from make your monthly repayment to your home loan, and that's it. It's not the case that you have to move all of your banking across to some non-bank that you've never heard of. The reality of it is you're going to have a loan repayment each month coming out of your CBA account to pay this Resimac loan, and that's kind of the only relationship that you have with them anyway. So it's not as daunting as it might seem. Right.
Okay. Another thing that I've heard that can be tricky is financing granny flats. How come financing granny flats is tricky? Or if it isn't, how come a lot of people think that it is?
Yeah, this is very flavour of the month at the moment, obviously, with people chasing yields. So the biggest challenge that you have with granny flats is really more down to the valuation. So let's imagine that you're going out there and you're trying to, build a $150,000 granny flat out the back of your house, let's call it. The challenge that you have is when the bank goes to value that project, it's not going to value at the current value of the property plus $150,000. Market conditions just don't support that. So what often ends up happening is you may be spending $150,000 on a granny flat, to get an increase in your yield, but it might only result in a $70,000 increase in the value of the property. So what that often means, if you're the consumer out there looking to do that, is you have to come up with quite a big cash contribution to be able to do it, because there's not enough equity in the property for you to be able to borrow the money to build this granny flat. So it's really more a valuation issue.
Okay. I think this raises a really, really important point, because although we've dispelled the myth already that yield is like super, super, super important, because as we just sort of talked about 10 minutes ago, yield is not the be all and end all, and there are a lot of other factors that can actually change your borrowing capacity. It's not just the yield, so don't necessarily focus on that. And in the way that a lot of people for years and years and years focused on positive cash flow, which we've discovered as a complete myth, a lot of other people, and I've spoken to tons, have been like, I only want to buy property where there's a value add opportunity. And what they mean by a value add opportunity is the opportunity to subdivide, or most of the time it's to put a granny flat or something like that on the back. And so there are a couple of problems with that. First, if you can do that often and you're on a subdividable block or a block that's large enough to have a granny flat, the development potential, it's already priced in. right? The development margin of once you've built it, that might not necessarily be priced in already. And when I say priced in, I mean it's already factored in by the vendor. But the development potential is already priced in. And then the actual development profit that you would make from actually doing the development, that's not easy to finance because of the way the bank's going to value it. So you've already got a couple of big negatives on trying to find that type of property. And this is something that I had a fantastic episode with Adam Hart, who's one of our property acquisition managers. Very, very senior guy, super smart guy that we have here at Dashdot. And he said one of the mistakes that people do is they really fixate on needing to make sure that they have a value add property where they can put a granny flat or something like that. And it's just sort of like a bit of an idea in the future. But when you do that, the number of potential high-performing properties that are in the market suddenly reduces by like more than 90%, because the vast majority of high-performing properties don't necessarily have that potential at the back. They're just a really good property in a really good location where whoever has built the house on it has built the house on it thinking that's the best product for the location, and not necessarily thinking, oh yeah, a property investor 20 years down the track might want to put a granny flat on the back, so I'll design it this way. So when you fixate on something like, I must have a value add, you're probably reducing your opportunities and thereby reducing your overall property portfolio performance. So, having said all of that, are there any solutions? If someone does find a block and they really love it and it does have the granny flat potential and they've cycled through everything in their own head, that we can't disabuse them of the notion that actually something else might be a little bit better. Are there any solutions when people just desperately want the granny flat?
As provided you've got equity in other properties, you can certainly make it work. Or if the debt position of the property that you already own is low enough such that you can just access that $150,000 of equity for you to go out there and build the granny flat, that's completely fine. It's just more of the challenge where the LVR position doesn't allow enough equity to be able to release to get that transaction to go ahead.
Once you've built it, does the valuation come in nicely with the $150,000 factored in? As like if the property was worth $700, you go and you finance the $150 that it costs to build it, $150 all in. Is your valuation likely to come back at $850, or sometimes it's at $820, sometimes it's $880? Is it really a coin toss?
Yeah, so I mean, certainly in my experience, it's usually substantially less. I mean, there's probably some markets around Australia where those market conditions, do give a substantial increase in valuation, but in my experience, it usually turns out to be less, and then starts getting this conversation of what's the return on equity and what I've actually done there versus maybe just using that capital to purchase another property.
Right. Okay, that's a very, very different environment we're in now than, say, we were 10 years ago then, I guess, which, again, probably underscores this idea of the rules that have worked in property investment so well 20 years ago no longer necessarily all apply, and we're in a different environment where we can use much more advanced and much cleverer strategies to make sure that we're squeezing every ounce of profit out of our portfolio. All right, that leads us to the next question, and this is one of those super popular ones. Lender's mortgage insurance. Is it refundable?
That's a good question. So that is bank specific whether it's refundable. So one thing you'll see in your loan agreement when you sign a loan with a bank, it actually says in the loan agreement the terms in which they can refund your lender's mortgage insurance. So most of the major banks, it is actually refundable within the first couple of years. There's time periods by which certain percentages of the LMI is refundable, but the basic answer is yes, with some conditions.
Okay. That's really important because lender's mortgage insurance is, how much is it these days? 5%?
Anywhere between, say, 2% and 5%, depending on whether we're talking a 90% loan or a 95% loan.
Okay, so if you have a 90% loan, what would be typical LMI on that?
2%.
2%. Okay, so if it's a $500,000 property with $450,000 worth of loan, 2% of that is going to put you at about $9,000.
Yep.
So that's $9,000 that you would have to pay as lender's mortgage insurance. But if you're with the right lender, I say the right lender, if you're with a specific lender that does refund that, would you be able to get 100% of that back? You get all $9,000?
There are some banks, yeah. Well, let's say, for example, you bought a property and then 6 months later you sold it. There are some banks where you would get all of that lender's mortgage insurance back, yes.
Okay. What if you simply put enough equity in to get the loan to value ratio up to 80%, would they refund under those conditions?
So under those circumstances, with the right transaction, you could get a refund, but it would involve a proper refinance. It's not as simple as just saying, hey, take my money, refund me the LMI. It actually needs to involve you creating a new facility and paying out that first loan.
Okay, and the expense of doing that may not necessarily be more than what the LMI is, or
no, it would certainly be a worthwhile exercise in most cases if you're able to do that. Definitely.
Okay, but the cash that you get in your pocket might not necessarily be all $9,000 because of the having to refinance and fees and things like that. You might end up with what, 8, something like that?
Yeah, something along those lines is more reasonable. Yeah.
Okay, that sounds like it's pretty decent. All right, thank you. That's great to know. One topic that has popped up a lot recently, and we mentioned it in the first episode, that was the topic of rent vesting. Now, for those who are hearing about rent vesting for the first time, shame on you. We've been talking about it for months and months and months at Dashdot. If you listen to any earlier episodes, it comes up in every sort of second or third episode. The idea of rent vesting is don't necessarily buy your principal place of residence. Buy investment properties first, let the capital grow, and then once the capital has grown and you've got a really robust portfolio where you're investing in optimal locations while renting, where you actually want to live in a really nice place to live, because where you want to live is not necessarily the place that's going to perform best from a property investment standpoint. So the question becomes, let's say someone has done that. They've rent vested. They're living over here somewhere really nice that they like, close to family, whatever, but it would be too expensive for them to buy. But they can get their money working for them, so they rent vest by buying investment properties. And let's say over the course of 5 years, they accumulate 2 or 3 or 4 investment properties in high-performance investment locations that, shameless plug, Dashdot have found for them. At some point, you do want to have your own home. So how do you buy your principal place of residence with the equity after years of rent vesting?
So there's a variety of different ways that could happen. I guess it really just depends on the constraints of your circumstances. So let's imagine that your borrowing power permits. It really could be as simple as just accessing some equity that you've got in your investment properties, using that as a deposit, and then funding a subsequent loan for this new owner-occupied property that you decided that you wanted to buy. But let's imagine that maybe borrowing power doesn't allow that sort of situation to occur. That's where you really want to lean on your buyer's agent to put together a property portfolio strategy on, okay, we need to sell a property, maybe we need to sell 2 properties. What does that look like? How do we map that out in terms of ensuring we can still keep some investment assets out there but be in a comfortable cash flow position for this new owner-occupied property? So it may be the case that you're buying this new house on the condition that you need to sell one of your investment properties. It's really that balance between borrowing power and then what the overall portfolio strategy needs to look like with the right advice.
Okay, so that sounds like if you've bought a couple of investment properties and then you have to sell 1 or 2 of them to buy the principal place of residence, why didn't you just buy the principal place of residence to start with in the first place? And I guess the answer comes down to, well, these are in better investment locations, so your equity would have been growing faster than if you just bought this one over here. And perhaps that means that you can get into a nicer principal place of residence. And it also gives you options to keep maybe 1 or 2 or 3 of the investment properties that you've accumulated in the meantime as well. Would that be roughly accurate?
Definitely. And if you had have done it the other way around and maybe bought the owner-occupied property first, there's a potential that you wouldn't have even been able to have the borrowing power to buy those investment properties along the way. So by the time you get to the end of it, you're in a substantially better position if you had have done it the other way around.
Okay, cool. We're at our last question. This is the last of many, many questions that have been sent in to us from various clients, prospects, and through our social media channels. What do I need to buy my next investment property?
In terms of capital?
Any sort of checklist or preparation tips for buying the next property, I would say. Common requirements, best practices, pretty much open season.
So the first port of call you need, number one, and maybe I'm a bit biased in saying this, but it's really a good mortgage broker because your ideas on what you're going to be able to purchase are really going to be defined by what lenders are out there and what they're able to offer you. So number one, start with the mortgage broker. Number two, you want to be in a position where you've got all your financial information ready to go for your mortgage broker. You've downloaded all your pay slips, you've got all your loan statements, you understand your living expenses, you've got all your ducks in a row to be able to present it easily to a mortgage broker or a bank for them to be able to quickly work out, hey, this is where the boundaries are set for you. And then once you've achieved that, then you really need to start to consider how you're going to go about purchasing that asset, which, obviously Dashdot is an amazing service, and I'm someone who uses buyer's agents myself, so you'd want to be leaning on your buyer's agent to ensure that you're purchasing the best asset that you can for that price range. But I think the preparation and the key parts are really the bit that's going to set you up for success in terms of what it actually could look like for you.
Okay, I would add to that, one thing that's really been impressed upon me recently is the importance of having a strategic plan. Looking at the theory of constraints, understanding capital, cash flow, and credit. And usually credit is a function of the first two, right? If you've got good cash flow and if you've got good capital or equity, then you should be able to get good credit. As long as, you don't have there isn't a postcode sensitivity or something like that. And so having a strategic plan and working out what is the constraint that I have at the moment? If I solve for that constraint, what is the next constraint that I'm going to have with the next property? And then the next property after that, and the next property after that. And working with a mortgage broker and with strategists, if you're working with a buyer's agency like Dashdot that has strategists who go through and can forecast what the different needs are going to be at the different growth stages of your portfolio. So I see this all the time. I see so many people get locked up. They see a good property, they make a bunch of mistakes, right? They buy in their local area because they know the area and they spend all day on realestate.com.au. They know every street, every property, and they can evaluate how much the properties should be worth, and then they see a bargain. And so they rush out and they get it because it's a bargain, and they feel like they're making a lot of money because they're buying 20 grand under what they think they could probably sell it for if it were their property. And so they find this bargain, but a whole lot of equity gets locked up in that, and then that means that they can't buy the next property and the next property and the next property. I just see so many, and I've been victim of this. I've made this mistake. I shouldn't say victim because I decided, right? But I've made the same mistake in my own investing in the past. You understand a location, you understand an area, you understand trends and things like that, but you don't get a strategic plan. You buy one property and it can be locked up for 5, 6, 7 years, not doing anything. Meanwhile, places in other parts of the country are suddenly moving. So I would say access to information is absolutely critical. To reiterate your point about having a really good mortgage broker, I would put it this way. If you have a really good mortgage broker with a good panel of lenders and who understands all of the nuances of the different structures and the different lending conditions and the different deals that you can put together, doors that you don't even know exist are suddenly open. And opportunities that otherwise would have passed by are suddenly ripe for the taking. And the acceleration, we had an episode with Andy Bernardos, who's a strategist, a senior portfolio strategist here at Dashdot. And we went through the different scenarios of getting things set up optimally versus not. And the difference can be decades in how quickly you can reach financial freedom. So that's a little bit of a shameless plug for Dashdot, but also a shameless plug for you, Callum, because I've spoken to a lot of mortgage brokers. And what I really like about talking to you is the level of expertise that you have specifically around property investing. You're not a sort of one-stop shop, we look after any kind of lending, but the depth that you go to in order to put together deals. Like, there's so many people out there who think, oh, well, I don't have enough money to do this, or I don't have enough cash flow to do this. But if you talk to a really experienced broker who understands this game to the depth that you do, then suddenly those opportunities are open to them. So if you are looking to get a property, you need some proper advice, definitely get in touch with Callum. If your question has not been answered, if you've got a question that you want to ask Callum or you would like to ask Dashdot, over the course of these 2 episodes, we've answered a lot of questions, but there might be some more out there. Drop them in the comments. We'd love to have Callum back on another episode, or we'll just answer them in the comments, or you'll get your answer, put it that way. On behalf of myself and Dashdot, thank you once again, Callum, for coming and having a fantastic podcast. It's always an absolute pleasure.
Thank you very much, Emil. Speak soon.
Cheers. Thanks. Bye.